Hello again, everyone. My name is Dominic,
And I'm Jimmy.
and on today's topic on our bite-sized stock market mini-series, we'll be discussing stock market indices as well as showing you some common examples of the most important indices globally. We will also be going through the importance of having such indices and whether it would make sense for one to put their money in them.
Wait, before that, disclaimer. None of the content produced in this video should be used as a substitute for professional investment advice, nor does it constitute an offer or solicitation for investment-related products. It will also not induce the creation of any binding legal relations. Okay, for real now.
If you're new to our channel, we are a group of like-minded individuals who are just as interested in the prospect of investing as those of you watching this video right now. And we thought, what better way to learn about investing than to teach it to others ourselves? And that was how this mini-series was born.
Now, most of you would have heard of this term somewhere before. If you have gone to central business districts such as in New York, London, or at Raffles Place in Singapore, you will be familiar with all the acronyms used by major indices. Examples of some of the most important index funds in the world include the Dow Jones Industrial Average, the Nasdaq Composite, as well as international index funds such as the Hang Seng Index based in Hong Kong and the Straits Times Index, which track large-scale Singapore companies. Dominic, could you please go ahead and break down what these indices comprise of?
We'll start with one example which both of us are deeply invested in, and that is the FTSE Straits Times Index. The Straits Times Index, or STI for short, is the capitalization weighted stock market index that is regarded as the benchmark index for the Singapore stock market. It tracks the performance of the top 30 companies listed on the Singapore Exchange. Companies listed on it include big names such as DBS, Singapore Airlines, as well as Keppel Corporation. These are all companies which are seen as integral to the economic development of Singapore. There are also traditional blue chips which Singaporeans would flock to since they offer higher returns as compared to storing your money in the bank. The Straits Times Index is jointly calculated by Singapore Press Holdings, the Singapore Exchange, as well as FTSE Group. However, as viewers of this channel, I believe you guys would think deeper, and I'm sure the question on all your minds is the stock market index a good predictor of economic health? The short answer is no. The long answer comes in the form of an example. Let's take the Dow Jones Industrial Average for example. The Dow Jones Industrial Average is sometimes used as a shorthand for how the economy is doing in the US. This is a habit that only seems to exist because stock prices change multiple times every second, meaning the Dow Jones data is faster to move and update than say traditional metrics like unemployment numbers. And in a sense, it is more exciting to watch and is seen as ostensibly more accurate as a monitor of economic health.
But it's a terrible habit. Case in point, look at what the Dow did the day the Department of Labor announced that 3.3 million Americans lost work in a single week. Objectively, that news should be an absolutely devastating sign for the economy, and if the Dow were a good guide to how the economy was doing, it would have reflected that.
Alas, the Dow rallied on some of the worst economic news in the nation's history. There's a logic to why it did that. It might have been reacting to Congress passing stimulus measures, but the surge still doesn't suggest that the economy is recovering. It just means speculators on a certain bundle of stocks are more optimistic than they were before. Nor was March 26 the first time this happened. 2 days prior, the Dow actually had its biggest single-day gain since, you guessed it, 1933. That didn't suggest that the economy was doing great in 1933, and it doesn't suggest that in the modern time economy is doing well either. Why is that so? It is because the Dow Jones Industrial Average is an antiquated, barely weighted average of 30 large companies, and not even necessarily the largest companies. And you should not even pay attention to it because it is seen as outdated and, in a sense, a lagging indicator. Indeed, you shouldn't even pay attention to well-constructed stock indices such as the S&P 500 if your interest is in how the economy is doing as a whole and not just how the stock market is performing.
Yes, definitely. In fact, if you look at all the rich people such as Warren Buffett, Charlie Munger, or Jim Russell, who have gone down in history as having an edge over the returns provided by normal index funds, they have invested most of their money into a select basket of stocks rather than spreading it out over 50 or even 100 companies.
The point here is that we are not trying to discourage you guys from diversifying your stocks. In fact, for beginner investors such as you guys or even an average investor, That is a good strategy that will almost guarantee your portfolio being able to weather through multiple economic crises without suffering too much damage. However, if you are someone who likes to look through a company's fundamentals or you have a large technical analysis toolkit on hand, you'll be better off cherry picking certain stocks that you trust and believe in. These stocks could have had steady growth over the past few years, or they could have experienced a catalyst in recent years, such as a breakthrough in an emerging market that made you think that way.
Yeah, for me, I like to look towards US tech stocks such as Amazon and Netflix. The returns provided by these companies far exceed what the S&P can give me in the next 5 years. For Singapore, I would like to look at real estate investment trusts because the dividends paid out by these associations are stable, regulated, and count as a readily available source of passive income.
We have come to the end of the video and I hope to clarify all your doubts. It will mean so much to the both of us if you leave a like and subscribe to our channel. I'll be flattered if you had one key takeaway from this video which you can share with your other friends. Leave any questions you have in the comments and I'll try my best to answer all of them thoroughly. Stay tuned for the next video in this mini series on market capitalization and invest safe.